Bankers flocked to DC, Bitcoin is swooning, and Apple's got a whole lot of cash. You're in the right place, folks, because this is where the money is. Welcome to the show, folks. It is Thursday. I'm Matt Copenheffer, and right next to me here is David Hanson. David, on CNBC today, Warren Buffett said that Washington will go to the point of extreme idiocy, but no further. Those are fighting words.
Fine with me. Hey, we're going to follow Buffett's wisdom here. I'll agree with him.
Would you go further than Buffett?
No.
Extreme idiocy.
That's pretty extreme. But he's earned it. He can be extreme.
I feel like he has earned it. All right, we've got a great show today. We're going to start, as always, with the headlines. And the first headline involves living wills.
Very exciting.
Yeah. Over at Reuters, U.S. regulators released biggest bank's second set of living wills. So when the Dodd-Frank regulations came through, one of the things that we would want to see next time around in some sort of major banking crisis is the ability for banks to be put into bankruptcy, to be wound down without the involvement of the government, without the involvement of extreme aid from the taxpayers. Do you think this gets us there?
I don't even know if we'd actually get to a point where this would be in practice and you'd actually have to do these things, but I think it's a good thing to make the banks look at their business.
You're saying 2008 never happens again, ever?
Well, I'm definitely not going to say that.
You heard it here, David Hanson.
I'm saying when crises happen, these things, it's very hard to go down a playbook and be like, well, we have a very organized living will here. It's all good. But I think it's good to have the banks look at their business and say, where are the risks? What are we not accounting for? Where can we better understand our business?
These are not the full living wills. So there are two sets of documents here. One is submitted to the regulators in order to be a public-facing document that the public can read. The other one only goes to the regulators, and the regulators examine that. I took a look a little bit more closely at the Bank of America's living will, and this is basically the overview of the number one strategy. There were a few resolution strategies that the bank is looking at, but here's what they wrote. Under one resolution strategy, BAC, the parent holding company, would enter bankruptcy by initiating a Chapter 11 proceeding after receiving certain capital or liquidity contributions from BAC, the operating subsidiaries would continue as going concerns while BAC is restructured, thereby maximizing the value and systemic stability. So essentially, putting the parent company into bankruptcy, giving it time to restructure, get its debts in order, but then keeping those subsidiaries operating, the bank, the credit card company, the overseas subsidiaries. Seems reasonable, except that it says this strategy would be the simplest approach. However, certain changes to the bankruptcy code and other laws and regulations may be required to facilitate this resolution strategy. Sounds good, but maybe not quite there. The other thing that I'll say is, this is about a 25, 30-page document, Bank of America's at least. I think it was a pretty interesting read. This isn't necessarily dry stuff. It actually goes through a lot of the structure of Bank of America, the different businesses under Bank of America, the different subsidiaries, as well as the actions that Bank of America has taken to simplify the business and improve capital levels over the past few years. So investors or potential investors, go to the Federal Reserve website, the FDIC website. Take a look at this. It's a good read.
Very exciting. Next article.
It's beach reading.
Next article is from Bloomberg, talking a little bit of Lloyd Blankfein here. And he was
Why wouldn't we want to talk about Lloyd Blankfein?
Of course. It says, Blankfein says finance CEOs urge action on debt limit. He, Brian Moynihan, Robert Benmosche, I think Jamie Dimon was included.
Oh, so you bet he was.
He was over there. They were talking to the president yesterday.
Bear was there.
Saying, okay, a shutdown, we have precedent for that. There's been a shutdown before. We've never defaulted on our debt, on treasuries there. So they were just saying, this can't happen. We don't know what's going to happen. If money stops, the quote he said was, if money stops flowing in, money's going to stop flowing out of the financial system. So I think they laid their case out. There's not much they can do. It's really on the policymakers. I'm thinking
of Lord of the Rings. You shall not pass. So Blankfein said, this is after he left the White House, there's a consensus that we shouldn't do anything that hurts this recovery. They shouldn't use the threat of causing the U.S. to fail on its obligations to repay its debt as a cudgel. Number one, I like the use of the word cudgel there. Number two, he's exactly right. I mean, the shutdown is bad enough, but as this gets closer and closer to that debt ceiling, that starts to get, that's, as they would say on MTV, I guess, that's where it starts to get real. And one other nice quote here. I think the the more people dislike Jamie Dimon, the more I tend to like him. And I liked his line here. He said, "We just want solutions. If people do the right things, America can grow aggressively and grow rapidly. That's what we should be looking for." Amen to that.
Always optimistic.
Mr. Dimon. All right, third headline, Wall Street Journal. Apple now holds 10% of all corporate cash. Moody's. It seems like it's a little bit outside of our sector. This is a little bit out. It's Apple, right? Here's what I thought was interesting. $147 billion in cash at Apple. As of the end of the second quarter, June 30th, American Express had $152 billion in assets. Regions Financial, $119 billion in assets. M&T Bank, $83 billion in assets. So Apple's cash pile is like 2 M&T banks. Should Apple take this cash reserve? I mean, we're looking for a new model for a bank. Should they start an iBank? Is this iBank time?
I don't think they should. I think they should stick with their strategy.
Carl Icahn's looking for a big share.
Yeah, I'll let
I'm
him
looking
have
for
his
the
thoughts.
iBank.
I'll let him have his thoughts. But you said this doesn't really impact, or doesn't. It's not our sector per se with Apple there, but deposits and corporate cash, they do impact the banking sector because a lot of these deposits are on the bank's balance sheet now. They're holding them as liabilities. And when the banks have these huge deposits, they don't have a lot of loan growth to lend the deposits out. Right. It can be a drag on the bank's performance. And not just in terms of loans. When you have big corporate clients like Apple, like the GEs of the world, when they have deposits with the bank, and they also have other services with the bank, so check clearing, wire transfers, all that other stuff. When you have more deposits, a lot of the times the bank will waive the fees on the other products. So it's kind of a double whammy for the banks. They have more deposits, they don't know what to do with them. And since they have the deposits on their sheets, they're waiving a lot of fees for their clients. So I think the banks are probably starting to say, enough deposits
let's be honest, even as Apple's cash balance goes down, you're still waiving some fees to keep Apple as a corporate client.
Yeah. All right, moving on to our next segment, looking at a couple more headlines, rapid fire style. First one is from the FT. U.S. judge holds key to the J.P. Morgan settlement. So obviously we've heard about the proposed $11 billion out there. This article was talking about the part involving the FHFA, so the regulator, now conservator, of Fannie and Freddie. And the proposed sum in that part of the settlement is around $6 billion, and the judge overseeing that is historically pretty stingy when it comes to big banks and big businesses. So it doesn't look like it's a clear path for JP Morgan just to get the settlement and get it out of the way. It might have to come back to the table.
Next headline, Deal Book. Greenhill expands into Brazil despite nation's woes. Greenhill is not a bank that we talk about very much here. It's a smaller boutique investment bank. It's a boutique investment bank that I really like. I think Greenhill is a very high quality, very well run bank, and for investors that like dividends, pays quite a nice dividend. This is Greenhill's. Greenhill's strength is outside of the U.S. That's part of the reason that U.S. investors aren't as familiar with it. They have a lot of strength over in Europe, for example. This is the company's first big foray into the BRIC countries, Brazil, Russia, India, China. Why are they doing it? Here's what, in the article, here's what Kevin Costantino, a managing director, had to say. It is where our clients want to be. If there's not a simpler, better reason to move into a geographic region, I don't know what it is.
All right. Next headline was from Bloomberg. REIT payout cuts spurred by Fed taper that hasn't come. And it was talking specifically about the mortgage REITs. And a lot of them have come out, cut their dividend. We saw Annaly cut theirs. American Capital Agency cut theirs. And the interesting part of the article was they're talking about the people who actually invest in mortgage REITs and the high percentage that are retail investors. So people like you and I, our viewers, our listeners out there.
Not like me, I don't know any. You do.
I do own one. And some of the numbers they threw out were more than 50% of American Capital Agency shareholders are retail investors. Over almost 70% at Armor Residential are retail investors. At CYS, it's around a third of the total ownership is retail investors. So if you're out there and you are a retail investor, just be aware of who else is holding the stock. And when we see these wild fluctuations, you could just there may be a little bit more volatility with the psychology of these things. When you see a dividend cut and you don't really understand the underlying business, you can make some impulse decisions and
there are probably a lot of those retail investors relying on those dividends too, looking for some other place to get reliable dividend income because it's hard to, you can't get that from fixed income as much right now. So.
And I think you just have to highlight yes, the big yields are there, but they're not without risk. You really have to understand the business. And okay, you could get 12%, but if the stock drops 50%, that doesn't feel too good.
Yeah. Final headline from the FT: Bitcoin price continues to fall following Silk Road raid in the U.S. You asked about this beforehand. Silk Road, which was allegedly an online place for drug trafficking, apparently, or not again, allegedly, did more than $1 billion worth of drug trafficking, paid in Bitcoins. So this was one of the places, I guess, where Bitcoin was actually used as a currency. We've talked about the potential uses of Bitcoin and have kind of settled on could be used as a store of value, but as a currency, not so much. Buying and selling drugs online, maybe better as a currency, but not anymore. Anyway, the value of Bitcoin was falling about 9% on this news.
Not fun.
Moving on to our focus for the day, we've got earnings season starting next week. We've got a couple of big banks reporting next week, but as we look ahead a couple of weeks, we've got some regional banks starting to report. So on October 14th, East West Bancorp and First Niagara will both be reporting earnings. The next day, M&T Bank. And then on the 16th of October, we've got US Bancorp, PNC, and KeyCorp all reporting. So as we look ahead to regional banks reporting earnings, what are some of the things that you're watching for, and how much does it differ from what you'll be watching with the big banks?
I think it differs a fair amount. And I think with regional banks, you really can't just say, well, this is the trend for all regional banks. A lot of these are very specific situations. A lot of them had a rough go-round after the financial crisis, and they've had different roads to recovery than kind of all the big banks that you look at. Wells Fargo, they've kind of just trotted through. Citigroup and Bank of America, they have been on a similar path, really struggled, and are slowly getting back. One of the first ones you mentioned there was First Niagara, and this is a very interesting bank. Were really aggressive with their acquisition strategy after the crisis. And if you look at the stock today, it looks like it is trading at a 20% discount to book value. But if you look over at the discount to tangible book value, which doesn't include the intangibles, so goodwill, a lot of it, you acquire that when you buy companies, it's actually trading at an 80% premium to tangible books. So there's a lot of goodwill in the situation from the acquisitions. And the stock has not been a good performer. It's been a laggard the last couple of years. And that's actually what forced the former CEO out of the company. So he was sitting there and he was saying, I think we should expand. I think this is the time to grow the bank after the financial crisis when we can get some pretty good deals. He went ahead and did that. The stock did not like it. He issued a lot of shares, diluted a lot of shareholders. He was forced out. The bank is still looking for a CEO to replace him.
That's a mess.
So it's a little bit of a turnaround story. There's been a lot of stuff going on at First Niagara, but this could be, when we talk about inflection points, when a company can really change its culture, this could be it. If they find a CEO, if they stick to making really good loans, because a large part of their balance sheet was an investment portfolio, not as much loans, and they're trying to focus on loans, good underwriting, good management, now that they have a bigger footprint. So that's definitely one to keep on.
I haven't looked as closely at First Niagara, but it's interesting that you say that, because it seems like that, on the face of it, that sounds like a good strategy. There were good deals to be had, particularly in partnering with the FDIC, and a lot of banks did loss sharing agreements. I imagine First Niagara probably had some loss sharing agreements. Maybe not on all the banks. That's as we got further and further out from the crisis. There were troubled banks that other banks bought but didn't get those loss sharing agreements. So that made a difference. But it sounds like a good strategy, and it's interesting that it's worked out so poorly for them. I would think that one of the things that investors might be on the lookout for as we move forward is, with such a disparity, it sounds like there's a good deal of goodwill, or a lot of goodwill on the balance sheet. Looking forward, companies have to annually test the value of the goodwill, the holding value of that goodwill on their balance sheet, to determine whether it still has that value. So if the banks that they acquired, so you in an acquisition of a bank, you would take on the goodwill if you're paying more than the stated book value of that bank. So if you pay above book value, you would take on some goodwill. So essentially what you're doing is you're attributing some franchise value or something like that to the acquisition target. So going forward, if you test that and you say, well, we're not getting the earnings power out of this that we assumed we would in the purchase price that we had, you've got to write that down. So First Niagara could be looking at non-cash losses going forward. It's questionable whether that's, I mean, you're already seeing the impact of what may have been a poor acquisition strategy already, but optically, that could look bad to the market if it starts taking these non-cash charges against it. I agree with you that there will be some major differences between the big banks and the smaller banks in the reporting. One of those will be trading. We're not going to see as much trading impact on the smaller banks. You and I have discussed here a few times the poor environment over the past quarter for fixed income trading. There'll be less of an impact on that for the regional banks. But there will be a lot of things that overlap. One of them is mortgage banking fees. So for the big mortgage underwriters, the big consumer-weighted banks, that will likely come down significantly as the refi boom cools off. Interest spreads will still be a big issue. I'm curious, and this applies to all of the banks, I'm curious if we're going to start to see any sort of movement back in the other direction, and the other direction being up after interest rates rose over the summer. And then finally, I will just be watching for management commentary, because I don't think enough has happened in the last quarter that we're going to see drastic changes, and I think that's really true for most quarters. So I'm always more interested in hearing what management has to say, what they think of the current environment, and what they're looking at going forward.
Right. And listening to management comments, two of the ones that I listened to earlier in the quarter were KeyCorp and Huntington Bancshares. Both of them said, we expect loan growth to pick up in the third quarter. And it's hard to say how much they were actually expecting loan growth to pick up, or they're just trying to be the optimist for their business. I may skew towards the size of them just trying to be optimistic. KeyCorp, their loan to deposit ratio, so just how many loans they have outstanding on deposits, is around 85%. And they said rest of the year, we expect that to move up over 90%.
Wow.
I have some doubts that that will happen, but I don't necessarily think that's a bad thing, because you don't want to see them just making loans to make loans to get on their books if they're not good ones. So those would be two banks to listen to just in terms of loan growth, because they're pretty conservative, well-run banks that are in commercial lending. So those are two to watch.
Sure. All right. Our game for the day is Fool in the Blank. And as the name suggests, it is we've got statements with blanks, and we're going to fill those in or fool those in.
Okay.
All right.
You want me to kick it off?
Yeah, go ahead. Give us the first one.
All right. Our first scenario is blank is the one bank I am most excited about. Get excited, Matt. Tell us the bank that you're excited.
Am I not excited? Do I need jazz hands or something?
You need them.
Right now, at the moment, and this shows how I can be just like a dog sometimes. I get a squirrel running in front. Oh, squirrel. I was taking yet another look at Bank of America last night, running through the numbers there. And I'm very excited about the deposit franchise at Bank of America. I mean, when you really break it down, what is it there that makes a bank, gives it staying power? And it's that branch network. It's that deposit base. And the deposit base gives the bank its earnings power, its huge earnings power over time, because you've got all of these funds there that you can lend out and collect that spread on. And right now we've got all of these factors working against Bank of America and a lot of other banks. For Bank of America, it's that high cost structure, a lot of it legacy crisis kind of stuff, and it's a low interest rate environment. But as I look going forward, I think the earnings power is there, and I think we will see that. How about you?
I'm going with Bank of Internet, and notice that the question was, or the fool in the blank was, the bank that you're excited about, not necessarily bank stock, and I don't own Bank of Internet, and I'm not running out today to go buy it because I think it might just be a little bit pricey, but when I look at the banking industry, I do get excited about the internet-only model. You just talked about the branch network. Polar opposites over here at Bank of Internet. They have one branch, their headquarters, as opposed to...
I will know Bank of America also has a very strong mobile and online presence.
They do, and I don't think this is a Bank of Internet wins, Bank of America loses. I just think it's an exciting thing for the industry as they move away from those branch networks. You can get lower cost deposits. You can operate them at a more efficient level. So not necessarily I'm running out to buy it, but it's one to watch. It's an exciting business to watch, Bank of Internet.
Way more efficient, too. The efficiency ratio of Bank of Internet
it's mind-blowing.
Is unreal. All right, let's go to our second fool in the blank. Blank is why AIG may not be undervalued. David? Fool in that blank.
Okay. I'm going bland here. Is that okay? Can I go bland?
Whatever.
Performance. Performance is the reason why AIG may not be undervalued, because everyone points to the price to book value. Oh, it's trading at a 30% discount to book. It's an automatic buy. No, not necessarily. There has to be the performance there to justify why that's undervalued. And so far, AIG, the performance right now doesn't justify that. But the investment thesis is over the next several years, the performance will justify it. But they have to perform. They have to write good policies and be good underwriters. So that may be a reason why it's not undervalued. What do you say?
Robert Benmosche may be the reason that AIG is not undervalued. And the reason I say that is I think Benmosche is a great leader and great for AIG, but won't be around for very long. And I think as AIG has shown us, leadership is very, very crucial. Greenberg ran such a tight ship for AIG for so many years, and then he left, and I would argue, he would certainly argue, and I'll agree with him, things got out of control. I think things got out of control after he left, and I think Benmosche has done a lot to refocus the business and bring a lot of sense back to AIG, but he'll be gone soon, and it's questionable what the new leadership, who it will be and whether they'll do as good of a job.
All right, our final fill in the blank of the day is blank is what Blankfein, that's Lloyd Blankfein of Goldman Sachs, should have told Obama yesterday. Matt, fool in the blank.
Big bluff. Big bluff is what Blankfein should have told Obama. He should have told him to go just really big and outlandish with a bluff to Congress if they don't get this, if they don't get this figured out soon. I mean, something like selling the White House. He was gonna go to Remax and contact a real estate agent at Remax, get a for sale sign out on the White House and say, this is how I'm going to work to put money in the coffers so we can get spending going. We need a big bluff from somebody to get things moving again.
I think he would have said, you're welcome. You're welcome for coming.
That actually sounds like something that Blankfein might say.
For coming to D.C., a place where everyone's watching and just saying, man, I just can't stand Congress. I know we talked about it yesterday. You disagree, but I think a lot of people were probably watching Blankfein's press conference, people on Main Street, and they're saying, oh man, I just got even more mad at Washington because Lloyd Blankfein's on Capitol Hill. I love him.
Didn't Benmosche say you're welcome? AIG as a group. I think AIG as a group said you're welcome. All right, finishing off as we always do on the Twitter sphere. David, give us the first tweet.
First tweet is pretty general here. We're looking at it from CTAL. Hope I'm saying that right. Bank stocks languish as thoughts turn to earnings. This is just referring to the last couple of days. Banks haven't been exactly world beaters. We don't really care about daily movements that much, but are you worried? Are you languishing because of bank earnings, or is this just a quarterly thing?
No. To the extent that they're languishing because of I mean, there are any number of reasons why they could, right? It could be government shutdown. It could just be the overall market hasn't been doing well lately as the government does its circus clown act. It could be the mortgage market thing. It could be the fixed income trade. It could be any number of things, but this is just one quarter. I'm not worried about that.
I agree. I mean, you think about, let's call it 20 billion or so at JP Morgan. It's going to start up here, flow down to shareholders, dividends, buybacks, book value. This is just a one-time thing.
All right, next tweet. We've got Nick Timiros. Mortgage rates fall for the third straight week to 4.22% for the average 30-year fixed rate loan from 4.57% in early September per Freddie Mac. David, are you running out to buy a home with mortgage rates falling?
No, but it's a little interesting. We saw all the banks cut not all their staff. They cut a lot of staff in the refinance department. Maybe we'll still get a little bit of life in the refinance, coming back a little bit as we see prices continue to move up. And if rates tick down a little bit, that'll bring more people above water on their homes. Maybe they'll be able to refinance. So maybe the refinance isn't completely over. Still certainly going to be lower than last year, but maybe there's just a little extra juice there.
Maybe, but this is really short term. This is like weekly.
Right.
And so right now with the government shutdown, there are legitimately things happening with the government shutdown. For instance, with the IRS, that actually will slow up the mortgage market just a little bit. And so I don't know how much this impacts. So we're going to want to look a few weeks ahead and see whether rates are still staying low then.
Right. All right. Last tweet of the day.
Assuming that the government's running by then.
Last tweet of the day. You're going to take this one to heart, Matt. Got it from JC Moretz. He says,
Why
Domino's pizza is disgusting. Who eats that, Matt? I know you are.
Why would you choose that?
I know.
That
I know you're one of the biggest fans of Domino's pizza. He is saying that it's disgusting.
It is not disgusting.
That's your rebuttal?
Look,
what is your argument?
No. Look, here's the thing. I grew up in New Jersey. I grew up in northern New Jersey. Northern New Jersey knows how to make a good pizza. I grew up on good pizza. So I know when pizza is disgusting. Domino's, it's not the best pizza. It's not New York City pizza. We just ate some of that a couple weeks ago. It's not New York City pizza, but it's darn good pizza. And I eat Domino's once a week, and it is very good, and I'm sticking by that.
What day a week do you get it? I know they have all those deals.
Sunday.
Not a 2 times, what is a hoo-ha 2 times Tuesday?
No. I get it Sunday. And on the Domino's app, which by the way is amazing. I love the Domino's app. You can set up your order and you can just repeat it every week. And so I have an order named Sunday Night Special. Boom. One button and I'm
Domino's
ready to go.
needs to come find you. They have their new spokesman. They just put a camera on you. You don't even need to pay an advertising agency. Just listen to this guy.
Good pizza, great app.
Perfect.
All right, folks. That's our show for today. As always, I'm Matt Copenheffer here with David Hansen. We are on Twitter at TMF Financials. We are also on Facebook, Motley Fool Financials. Please send us your questions. We will answer them live on air. You can also find us now on Audio Edition on Stitcher and on iTunes. Thanks for watching. We will see you tomorrow.